Good afternoon. Welcome to our next meeting of the May Revenue Estimating Conference. Today on the agenda, we'll be discussing tax collections, and we have a group of people from the Department of Revenue here to present to us. And we can start with either Nina Savage or Marilyn McConaughey if you want to do some introductions before you give your testimony. That'd work for us.
Yes, thank you, Sharon, members of the committee. Thank you for this opportunity to address the questions that were forwarded to the Department of Revenue. Nina and her tax team and the Central Collection Unit and Department of Motor Vehicles, Division of Motor Vehicles has spent considerable amount of time addressing those questions. We suspect you may have more as time goes on, and we'd be glad to submit written responses to those. But with that, I'll turn it over to Nina for the introduction of her team and the presentation to begin. Thank you.
Thank you, Director McConaughey, for your support and guidance. As always, there is much data to be presented, and there are many people who did the work behind these numbers and other people who assisted in putting this presentation together. With me today are Michael Canole, Rahul Sarathy, and Kristen Cipriano. I want to thank them for their work and support, and also especially recognize a few other people on the team. Dan Clements, Donna Dube, Susannah Coburn, Laba, Carlita and Acelli Teresa Brady for their work in compiling and doing the hard work behind some of this data. What we're going to do today is I will go through the questions. Many of you are familiar with them. There are about 100 or so slides. I will speak and pause at various times for questions, and I'll try to say the page numbers also, but remind me if I don't. At the end, I'll provide a brief update on the impact of COVID-19 on the Division of Taxation, then turn it over to Edmund Murray of the CCU, who will then turn it over to Director Craddock of the DMV. With that, we'll get started. And Rahul Sarathy is going to share his screen. It's just easier for me to manage the presentation if I'm not doing both. So here we go. Question 1, page 2 is the Historic Preservation Investment Tax Credit for both the 2008 and 2013 programs. This is by project completion date, which is the calendar year. Used amount is $425.7 million. Unused amount is $7.83 million. Fiscal year usage was about $13.14 million. Next slide is the same data by tax type and fiscal year. Major usage for FY21 is income of $8.8 million. Insurance HMO is about $4 million. Page 4, question 2 is the monthly historic tax credit fund transfer data, which reconciles to the fiscal year usage on the prior 2 slides. Question 3 is a summary of the processing fees. This has had no change since November. Just a summary of the processing fees and where we are with respect to abandoned projects and the number of projects that have been reduced by audit. Page 6, question 4. This is the 2008 program only. We're down to the last 2 projects with 2 phases. In November, we had reported that the 2 projects would be completed in FY21. One of the projects was pushed out into FY22, and the QREs are estimated at $46.2 million, estimated credits at $11.5 million. Page 7, question 5, again, is a summary of the available credits under the 2008 program. Then the middle part is a breakout of a summary of the abandoned projects. And the bottom part, you'll see a change in November in the credits available from projects that had credits revoked. There was one project revoked, approximately $500,000, which caused the credits available to go up by $500,000 since November. Question 6, page 8, is an update on the 2013 program and the how it was funded. The middle part of the slide is the contracted projects and their status. The difference from November is in the middle part of the slide. You'll see that the in-hearing or hearing window forfeiture of credits went up by 6 since November. You all are familiar with the remain idle provisions. We sent letters, and those are indicated in that area. There was also one additional completed project, so the completed projects above went from 40 to 41. The total in the middle of the page, back to page 8, is 37.1 million is from the 7, 3, and 1 that are in the middle. We had to total those because of the number of projects. The projects remaining in the queue, which is question 7, page 9, went up by 3 since November to 39 due to the completion of the project. The next couple of slides are on the motion picture production tax credit. Again, by completion year, calendar year date on the left, a total assigned amount is 90.34 million. Unused is 2.6 million. You'll see a large usage in fiscal year 21 for 1.2 million. There's a note that we typically testify about carry forward credits. That usage is from a carry forward credit. Question 8A is the same data broken out by fiscal year and tax type. Again, business corporation, personal income are the primary tax types being used. Question 9 is the motion picture production company tax credit waiver request. We have not received any requests in fiscal year 20 or 21. Question 10A, B, and C are the newer. Actually, we start out with the older tax credit programs, then we go into the newer commerce credits and break them out. On the first page 13 is a breakout of the older credits by tax year, and usage for tax year 19 was 9.51 million. Tax year 20 year to date is about 1 million. 10B, page 14, is the investment tax credit, which was the change in the FY 2018 budget. For unused carry forward credits, again, this is not to allow new credits to be issued, but to allow older credits to be used. And the amount for fiscal year 21 was 3,000. Page 15, slide 10B, are the Commerce Corporation credits, and these are by tax year and then by redemption. They have a variety of ways that they can be used depending on the program, and the usage is indicated there. I would also like to point out that for the first time you're seeing the traditional TIF allocations. That is subject to appropriation under statute, and these have not actually been issued but are earmarked to be issued in FY21. Page 16 is the investment tax credits and other major credits for rebuild, and this is a breakout of rebuild similar to what we did on historic and motion picture by tax type fiscal year. Rebuild has credits are issued for up to 5 years upon certification by the Rhode Island Commerce Corporations, and they cannot be used until the tax year denoted on the tax credit certificate. So this is a little different than historic, but the usage as these projects complete are indicated with the various 10% reduction on redemption also stated. On the further breakout of the rebuild is by tax year and by tax type on page 17, question 10C. Question 11 is the historic Jobs Development Act rate, which is an older program.
Excuse me, Nina, can we pause? I've got some questions here.
Sure.
Steve.
Thank you. Nina, on page 16, question 10C, I'm looking at the redemption 90% line. How's there an unused amount? I see an asterisk, but I don't see a note on the page explaining it. But how's there an unused amount when they're doing the redemption option?
We can get back to you. I want to check in with our team and provide an accurate response. I'm just not sure, but we can have that as a follow-up.
Okay, thank you.
While we're paused, Jonathan, you guys got any questions thus far? I guess no.
We're good.
Okay, thank you. Go ahead, Nina, thank you.
Okay. So I was on page 18, I believe, with the JDA and the breakout by tax year and tax type. Again, this program is older for businesses that get the rate reduction based on prior entry into the program. This is not an ongoing program. 11A is the same, page 19 is the same information by fiscal year and number of filers. Page 20, we're getting into this year's question 12, which is the tax season. The last two tax seasons have been extended based on the IRS extension and our tie to that statutorily, regulatorily. So the first several slides will indicate a pattern of returns and refunds. As you can see, we have the return filing for tax year 21. There was a 3-week delay and some uncertainty surrounding federal tax law changes. So we're seeing eventually getting to the tax year, or 2020 tax season rather. We're reaching those amounts, but we've highlighted the extension dates and the where we are showing some of the data. So that's page 20. Page 21 is the historic graph showing cumulative refunds issued by week of calendar year. Again, there was a 3-week delay, uncertainty, and we have a number of first-time issues in Rhode Island, including individual mandate, which is the shared responsibility payment, and that those returns are taking a little bit longer to work. Additionally, because of the unemployment compensation fraud, we're looking at those returns more carefully, and we're sharing data with DLT to take a closer look. We're not finding anything troubling or anything concerning with respect to those returns, but we feel it is prudent to take a closer look at those. Question 12, again, is the cumulative count of refunds issued by week of calendar year, just to show the trend lines. Page 22. Page 23 is a fiscal year-over-year comparison. The difference between year-to-date May last year and this year, you'll see, is the fraud queue, which is the error audit register queue, which is actually lower. In the next several slides, we'll show a historic comparison of where we were May 1st for prior fiscal years and November 1st. So we're about on a fiscal year basis, about 15,000 refunds behind, and in terms of about $8 million. And again, we think that's due to some of the first-time issues with respect to federal tax law changes and DLT UI issues and sharing that data, and also a closer look at some of these returns. On page 25, these are the historic Qs, the clean refund amount. You'll see that the dollar amounts are a little bit lower. Clean refund amount is, compared to processing year 20, is lower. And this is where this is the increase in the potential fraud, about an 8 increase, and a $19 million increase. We're not finding any issues, but we are taking a closer look at this. In terms of the error register, the dollars are lower, the numbers are lower, and the other information we've been over. Does anyone have any questions? I know this typically, I want to pause here for a minute.
Nina, I think, yeah, this is a lot all at once, so one thing that we always have a little bit of trouble with is understanding kind of what some of these, what the fraud queue means. You know, does it mean that these refunds are likely to not be paid? How much of this is old fraud? How much of this is fresh?
We can provide you the, our team is saying they're having a little bit of trouble hearing you, Sharon.
Sorry, is that better?
Yeah, that's better.
Okay.
We have the historic data, and we can follow up and tell you what tax years. This is what I can tell you is the potential fraud are the best way to are anomalies and analytics that we're purposefully holding on just to take a closer look.
And so you'll get back.
In terms of,
Go ahead.
no, finish.
I was just thinking, on slide 23, it's called fraud queue, but that's the same exact number as potential fraud count. So this is all potential fraud, and this is all unique to processing year 2021, not any of the items from 2020. Is that correct?
Yes. I think there are a lot of first-time issues, including people filling out the independent mandate portion incorrectly. 98% is 2021.
So you say with people filling things out wrong, that's in a fraud queue or on the error register?
It could be in both, depending on the degree to which they filled it out. It's not duplicative, but it depends on the analysis and the and the issue. It's hard to generalize across those things. So,
and then, with respect to the late filing season, both it got underway late, and then there's a month delay on when returns are due. Some of that is explaining the low number of refunds. Is there any sense that under withholding, particularly for those who had unemployment benefits, is also explaining the low refunds?
we haven't done that work, so it would be, I don't think it's prudent for me to comment on it. I don't think we've done that correlation. And we're not sure.
Okay, other questions on this from anyone else before we keep moving? I don't see any.
Okay.
So go ahead, thank you.
Let me just going to start on page 26, question 15. Just give me a second. The earned income tax credits by resident and non-resident are broken out, and they are, just a minute. Again, these numbers will go up as the extension date goes up. One thing to note is that the Consolidated Appropriations Act change, which allows basing 2020 refundable EITC on the preceding year's earned income effective for tax year 2020, is the only one that's effective for tax year 2020. And we'll get to that in the ARPA slides, but all of the ARPA tax year changes to EITC are to tax year, other than that one, are to tax year 2021. And just on page 27, question 16, property tax relief. Again, this is the 1040H filers, and this is low given the due date extension, but most of these returns come in earlier and they've been declining over the past several tax years. Page 28 is an analysis of withholding payments over 500,000, which is almost all same as all of FY20, fiscal year 21 is 77.8 million, which is almost the same as fiscal year 20. Just want to point out, to the extent that there was a large payment in March of 2020 for 6.1 million, we did review that. We think that is a non-recurring payment. On question 18, page 29.
Nina, hold on one second, please. Steve has a question.
Thank you. Nina, there's a 7.8 million in April. So if you're not calling that out, you think it could be recurring?
No, a lot non-recurring. So any of the large payments, we looked at both of those, and they're both non-recurring.
Okay. Kind of what's your cutoff for looking at individual payments to try and determine if they might be recurring or not?
In terms of when we
like dollar amount, or which ones on, I don't want you to go through every one necessarily, but
right.
Like on this sheet, do you look at each of them and make a determination? Or
when we see a spike over $1 million, or we look at we did the analysis several recs ago, and I think we look at all of the payments and see any spikes either periodically or by taxpayer to the extent we can. But if we over 1 million, we usually look for a trend.
Okay. I wonder if maybe you and your team can discuss it, but potentially for future conferences, as you come across the non-recurring payments, if they could be somehow marked on the sheet, it might be helpful.
Okay.
Thank you.
All right, thanks. On question 18 is the personal extensions. Again, the due date's been extended. We have about, in May 2020, we had about 834 for 3.6 million. This year we have 1,535 for 15.3 million. And as you can see from there, we had 3,000 fewer returns with the July 15 extension than we did in 2019. That's that. Page 30, question 19 is the Public Employee Compliance Program. These are letters that we sent to agencies, public agencies pursuant to 44-69. And we send the letters in August, notices to public employees in December. 9 additional public agencies, 36,000 employees, The collections and the number of returns as indicated on the slide are up. Page 31 is the question 20 is the contingent fee contracts. This is the tax compliance improvement project. This is one area where we didn't, as you can tell from the costs by SOW, we didn't get to as many as I testified in November. We had one of our team members pass away, and it's been due to vacancies and other issues year for our office audit and our audit team. We expect this to increase in FY22 as we catch up. However, this is one of the areas where we noticed a decrease. This contract is due to expire in FY21. It's under review. We will continue to do all of this work and break out this data for you in the same way. So this will continue, and this is one of the areas where we've seen a decline. Page 32 is the same information broken out by fiscal year and tax type. Page 33 is the transfer pricing breakout by month, and this has no update. Individual mandate, this is the shared responsibility payment enacted effective beginning tax year 2020. And again, we had about 8,780 taxpayers that paid through that were attributed 3.86 million. About 1.3 million was actual cash collections, and the remaining about 2.6 million was offsets and credits from withholding and other types of credits, such as EITC. We did a Refund journal transfer from personal income tax to HSRI for the first quarter of calendar year 2021 in the amount of about $2.5 million, and that exact amount is stated. Question 22 is the breakout of the minimum filers versus non-minimum filers. Again, this is based on payment type and a little bit higher than May of 2020, but that may be because the more filers have filed. On page 36 is the breakout of question 23 and 24 of receipts for business taxes. So what we've done is for all of the business taxes, estimates, extension payments, and final payments are broken out. We've also included the pass-through entity payments, which are the basis for some of the increase in these categories. I did get, and then for 2020 is page 37, 2019 is page 38. We did get a few questions from accounts and controls on Friday and Office of Revenue Analysis about court PTE and pass-through payments. Again, and so what we've provided additional data. This is the best information we could get you to try to link, which we don't think is possible given that the filing date has not passed. So a number of things to note with respect to the PTE workaround. This is typically for the most sophisticated of taxpayers who are taking advantage of this. As you know, the estimated payments for this did not start until September of 2019 for estimated payments for tax year 20. And therefore, we've put in the counts and the amounts by month. And the first slide is the first 6 months of the fiscal year. The PIT pass-through extension estimate and finals are there only for comparative value to show you trends of the number of payments. The other thing I want to stress is that the counts are numbers of payments and not taxpayers. Because we don't have these individual income tax returns, it's very hard to track the entity level payments and show how they flow through to the individuals. And the question of the day, which is how much of the entity level payments will be are duplicative of individual payments and how much will go out as refunds. As you know, an individual's ultimate tax liability is based on income loss, credits, payments, and carry forwards or refunds. So it's very difficult in these complex entity structures to show how that tax liability flows through. So we've provided as much data as possible. This will be a manual study of tracking the entity level payments down through to the individual returns. We simply don't have that data right now. It's something the team is looking at and trying to prepare an analysis for. So we've given you as much data on the number of payments to show the trends. One thing I will point out is in December of 2019, we had 530 total payments. In December of 2020, we had 1,773 payments. That was after the IRS validated the SALT workaround as an appropriate measure. So after the IRS's validation, I think before participation was low because the IRS had not confirmed it. We will likely not have the analysis of how these payments flow through to the individual level, to the individual taxpayer for this REC. We're going to try to study it this summer after we get the returns to give you some indication. Again, there will be some that will be foregone revenue and other amounts will be actual cash refunds. Are there any questions?
I think we're okay.
Okay. Thank you. Page 41, question 25 are the public service by, and just a minute. May 21, I will just note that telecom is up by 3.3 million and electricity is down by 2.2 million, but this is as of 4/24, and that may come back up when the month closes. Bank excise, you noticed in the historic tax credit slide that and in November we testified that there was a large payment in 2020 for bank excise that we expected not to be recurring. That payment was again received in March of 2021, and therefore we backed out and readjusted. We backed out that recurring payment and readjusted the estimate, or we included it rather. Sales tax refunds for EDC, Rhode Island Industrial Facilities on page 43. Again, those are historic programs, historically old programs, and Rebuild also has a sales tax refund component, and those refunds are indicated by fiscal year. License block program, as I reported in November, we did not do proactive collections given COVID, and in spite of that, and a lot of the calendar year 20 notices were based on non-COVID debt, the debt wasn't due to COVID. This year, We did send out 7,329 notices, and some of those debts may be related to COVID. And again, we have a COVID insert. We work with taxpayers, and as we've put in our insert, we have a statutory duty to remind taxpayers to pay these trust fund taxes. Question 45 is the expansion of sales tax to certain services. Again, this is based on the filing of the annual reconciliation form. We have comparable number of filers from May of last year, and you will see that the number of pet care services is the same. It's about, but it's gone down by about 1.4 million. The number of taxi cab service filers is down by about 3 million, and SaaS is down, but the revenue is still up. Same thing with security services and specified digital products. I think the challenge in these annual reconciliation forms is that people are not filling them out correctly. Where we have large filers, we're proactively reaching out to them, but they're not categorizing the type of service accurately, and we have noticed this. There's no enforcement or compliance means to enforce this, so we are in a position of reporting what we get. Remote seller activity. This is a series of slides to demonstrate both the remote, local, and combination. So these are businesses that are remote. They're truly remote. On page 47, they don't have a brick and mortar location in Mass, Rhode Island, or Connecticut. The other is mixed or other, and the green is local only, with which is just a brick and mortar location in Mass, Connecticut, or Rhode Island. Mixed or other means they have brick and mortar and a remote seller presence. So as we've noted, sales tax is going up, and it's incrementally the remote sellers are going up. The best indication of this is page 49, the actual numbers. And from 2017 to 2020, you can see that sales tax has grown by 800 million or so. And the mixed or local, they're all going up, but the values in the remote is going up incrementally more. Self-audit, this is a program, again, as I said, we're rebuilding our audit team, and we expect to roll this into other analytics programs. This is something we did try in the collections by indicated there. Page 51 is the use tax collected on personal income tax forms. We believe this number is going down due to the changes in the remote seller and marketplace facilitator, expansion of the internet and sales, electronic marketplace sales. So less people are feeling a need to file it on their personal income tax form. This is the cigarette tax stamp roll sales, and this has gone up, and we're seeing a trend increasing for fiscal year 2021 as well. Status of e-cigarette sales, there's been no statistics available. We don't break out the sales tax on specific e-cigarettes. This is a question tied to a fiscal year 18 initiative on organizational change and revenues tied to that. So we have tracked certain initiatives that are integrated within our organization. I've presented slides on our organizational change in the past. We took those out and focused on the metrics. Due to COVID, we did see a decline in collection payments. However, due to vacancies, it's not as much as we had expected. So this is 26.4 million per collection payments per revenue officers went down. We think that is also caused by vacancies within the agency. Collection pay initial collections payments July through April is shown there on page 55. Initial bill payments, we think this number did go up due to the due date change. We typically start billing after the filing due date, and this increase is attributable in part to that. Revenue from DMV block is 554,739, including broken out by penalties and interest and tax. Page 58. We did shift over because of challenges due to COVID and doing proactive collections. We have automated our top 100. It gets updated automatically, and the collections team shifted gears and focused on the top 100 and did proactive collections, and those revenues went up from 1.2 in FY20 to 1.4 in FY21. We've seen a lot of improvements in the letters of good standing. This is an issue that's of interest. I just wanted to note that we are down to 2 business days for letters of good standing with no issues. Refund offset program, we have seen a decrease in this, primarily from DHS and DLT records not being sent. There were a number of agencies that also requested we not offset, including higher education and a couple of others. So this is a calendar year metric, so we expect this to go up. I should note, we are systematically, our IT team is reaching out to each of these entities to remind them that we have the service available and that we are here to take whatever debts and liabilities and offset them to the extent they need them. This is our field audit staff, and our fiscal year overall dollars assessed is 20 million. You'll see the anomaly year of 58 million. That was due to 3 large audits closing that year, and those audits were not expected to be recurring. The team, as I said, it's been a rebuilding year, but they are doing well. Office audit, this was some of the data that you saw in the TCIP. The automated programs are at the top, and it's been 5 million in collections from fiscal year 21 year to date. Fiscal Corp, as soon as accounts and controls closes the month, our team will start working on this and will provide it hopefully within the next day or 2. Alcohol beverage gallonage report. There's been an increasing trend across all of the components here. This is the SIU update. Again, another fiscal year budget initiative, and we wanted to provide metrics to show what the team is doing. Again, this is based on voluntary compliance. OTP revenue is going up. Our investigators, while they were assisting other agencies, did notice a lack of compliance in the marketplace due to a lack of presence by on inspections. You'll see this is inspections by calendar year by our cigarette enforcement staff. In 2020, we did 1,302 inspections and the seizure percentage was 6.63. So far, year to date, we have done 1,107 inspections. Resulting from some of those inspections are enforcement actions, and there are often applications that have to be scrutinized closely and resulting in administrative denials and hearings. So those numbers are indicated: number of applications approved, denied, withdrawn, and pending. This is the total number from the seizures that we and the assessments across fiscal year 20 and 21. We're still continuing to assess fairly large dollars, and we think that's attributable to the team not being present in the marketplace. We're seeing more activity, contraband activity in the marketplace. Again, when seizures are made and assessments are sent, there are administrative hearings that resulting in decisions and settlements, and we have 56 pending administrative hearings, 7 settlements so far, and 49 others pending. This is a fiscal year 2015, page 77, which is the Misclassification Task Force update. Again, even with COVID, the employer tax unit on page 78 did 348 audits. You'll see that while the number of audits and number of individuals misclassified were lower, the tax interest and penalty year over year was higher year to date. Page 79, the expanded occupancy tax. This is the 13% on rooms and the 8% on entire homes and condos. We have 10 filers on the hosting platforms, room resellers for $4.2 million, and 111 realtors and homeowners for $2.4 million. Real estate controlling interest, page 80, is fiscal year 21. We have seen 171,000 year to date. Legal costs, this was a fiscal year 2018 Appropriation Act. Although we asked for legal costs in all of our administrative proceedings, we have not had opportunity to pursue this. This is the TCJA update from tax year 28 on page 82. 83 is tax year 2019. Page 84 is this year's. You'll see the net guilty income apportioned to Rhode Island is 2,110, and the FDII apportioned to Rhode Island is 245. The page 85 is last year's due date change, just as an informational slide. We wanted to include this to show you the difference between last year and this year. Last year we did, again, this is from November, we did the estimated payments, final payments, and April over April comparisons and the difference. Page 87, again, historical tax year 2019 comparison. And page 80 are all from November. Page 88 is from November. 89 is from November. 90 is this year's due date change. Just to tell you what forms and payments actually did change to May 17th and did not change. This is to aid the conferees on showing the limited nature of what was actually extended and what was not extended. Again, this is page 91 is the April comparison and estimated payments, final payments, April 2019, April 20, and April 21, to show you the difference between the April 19 to April 21 payments by tax type and component. The next question is page 92, and there's a series of questions on the federal impacts on tax collections of the CARES Act, the CAA, and ARPA. Just a few general comments on this. These laws, we reviewed all three laws, both first with the tax team, then with Office of Revenue Analysis, and we also had outside counsel take a look at some of the provisions to make sure that we were not missing anything. After that, we took a look at, and we wanted to make this as clear as possible. These are highly complex, highly nuanced federal and state tax provisions, interrelated with very little IRS guidance. As we've seen this year, the IRS takes one position and the federal government passes another law to undo that provision. So we are looking at historically first time issues of first impression, the tax calculated and tax principles about deductibility of expenses using tax exempt income. These are first time principles of tax policy and interpretation that are unprecedented. So to try to analyze this all, we wanted to put it forward in a way that would allow the conferees to track this should any guidance be forthcoming. So what we did with page 92 is your historic CARES Act slide, and we put in CAA and ARPA updates in blue. Again, on the recovery rebate for individuals, the CAA and ARPA extended and clarified with no impact on Rhode Island. Again, it's a credit. On number 2, the special rules for retirement funds, minor change to CAA to money purchase pension plans, and there's no impact other than what has been previously identified by Office of Revenue Analysis. I'm going to shift to number 4. Again, the partial above the line deduction was amended by the CAA Section 12, no impact. And again, without IRS guidance, it's likely that it'll be below the line. The loss is indicated there as estimated by Office of Revenue Analysis. Number 5, again, no impact, and then undeterminable impact on business corporation tax. And this was extended through 2021. On the exclusion for certain employer payments, this was applies this provision to employer payments after March 27, 2020, but before January 1, 2026. Those fiscal year estimates remain the same. No changes
Nina,
to
can I
the...
stop you for a minute, please? I just want
Sure.
to make sure I'm reading the items in blue properly. So
Okay.
number 4, allowance of, the charitable contribution amended by the Consolidated Appropriations Act. And then it says no impact from the Consolidated Appropriations Act?
That's what we think, and I can follow up and provide a more detailed explanation on that, if you'd like. But that's where that's the best analysis we have. I can explain that further.
Well, the reason I ask is because the block next to it.
It's below the line. Yeah.
Right. So this one is going to be below the line. The other one, the other one was below the line, no? Or are you using below the line?
No, the
differently?
300 was above the line.
Okay.
And this new charitable deduction, the analysis shows that it will likely be below the line.
Okay. All right, and so I think I was just, it was, the 300 was regardless of whether you itemized originally.
Right.
So
Exactly.
semi below the line. But I see what you're saying. Okay, thank you. I just wanted to clarify that.
Okay. The next page is the CARES Act breakout that we did in November. No change to any of this by CAA or ARPA. This is something you've seen before, and this is the excess business losses. The first decoupled was what we had proposed, and that was a breakout of how it would be a shifting forward of the losses based on an initial, because this allowed taxpayers to retroactively amend tax returns for 18 and 19. So,
Can I stop you again?
Steve.
Sorry, Nina. I got
Sure.
a question from Steve.
Thank you. Nina, on all these federal impacts, is there anything on the timing of any of them that we should know, like the provisions? People are going to have to file amended returns or something, so we wouldn't see it in our numbers to date, or are most things going to show up in the normal flow of returns coming in?
I think on the excess business losses on page 94, that's certainly a prior year change. Everything else you'll see in a minute when I get into, this was the big CARES Act issue that we identified over the summer, and this is the only one that would impact amended returns. I have effective dates on the others, and on ARPA's, I don't think, the American Rescue Plan, I don't think we will see those yet. So this was the only one with retroactive year increase. Now, we haven't gotten into the unemployment issue and PPP loans yet, but I think this is the only one. We've put in effective dates on the following slides, so maybe if you still have questions after I go through those, we'll try to break it out further. Does that make sense?
Thank you. Yep.
Okay.
Matt, did you have a question or?
Yeah, so on the excess business loss provision, just so I'm understanding what ARPA did. So did it push the sunset change out from the end of 2020 until the end of, or until I guess 2026, basically, or 2027?
It cheers, yes, I believe so. So it just extended it by a year from on or before January 1, 2026 to 2027. So it just extended a year.
So there's no further revenue impact from that extension?
No. Other than, let me get back to you on that because I don't want to guess.
Okay, the slide 93 says sunset, so on line 3, sunset taxable years after 12/31/2020.
So,
Ended in 2020, but now it's ending in 2027, or I guess really 2026, because it's January 1st.
okay, I think we may have,
Any more impact from that, I guess?
right. And then going back to page 93, I just want to show that the 18, as you know, the payable that was booked by accounts and controls. I think we updated on page 93. That was an update from ARPA. That is an update from ARPA. So I'll clarify that, Matt.
Okay, thanks.
On page 95, so we took a look at the Consolidated Appropriations Act, and there are 3 categories of impact: those with no Rhode Island impact, an indeterminable impact, and those with discernible impacts. So for both CAA and ARPA, we broke it out by those with no Rhode Island tax impact, indeterminable, and then we worked with Office of Revenue Analysis to identify the impacts of on those that we could calculate based on data that we had. So these are the provisions with no, on page 95, with no Rhode Island impact. As you know and are familiar with, the PPP loan forgiveness and deductibility of expenses that came out as a result of the CAA provision on expense deductibility. This is updated data from Office of Revenue Analysis. The first is with the current conformity, and it's SBA data as of April 13th, 2021. And the next is with the Article 26121 proposed 150,000 and above state tax. So those are the numbers. You're familiar with this discussion.
Steve.
This slide is.
Sorry, Nina.
Go ahead.
Steve has a question.
Sorry, back on PPP and question 49. These numbers are fairly different than what we had seen before. What was the SBA data that you received?
So Office of Revenue Analysis did this, and I believe their last estimate was based on January SBA data. So they pulled these numbers for updated April SBA data as of April 13th, 2021.
They went down though, right? By several million. And then the spread between years is very different than how it initially appeared. Did SBA provide taxpayer-specific data that we initially didn't have, or was this?
No, the SBA hasn't provided. It's all public data that Office of Revenue Analysis is using, and I can get further clarification on the change from January to April, if you'd like.
Thank you, yeah.
Page 97 are the indeterminable impacts from the CAA 2021 provisions. And again, as I stated on the EITC question earlier, individuals under CAA may base their 2020 refundable child tax credit and earned income tax credit on preceding years' earned income. This applies to tax years beginning 2020, and we simply don't have the data to determine how to calculate that. In terms of temporary special rules for health and dependent care flexible spending, that's a tax year 2021 issue. And again, we have no way of determining the usage of that. The final is the EIDL emergency loans and certain loan forgiveness, and this is for tax year ending after March 27th, 2020. So this will be a next filing season, or this filing year issue, and we don't have the data to determine that as well. The next slide, page 98, is ARPA provisions with no Rhode Island tax impact. Again, we did the same thing. Suspension of tax on portion of unemployment compensation. Again, Rhode Island currently taxes unemployment compensation. However, there is a bill to decouple from or recouple, and that estimated impact is updated to 27.8 million. And that estimate is from Office of Revenue Analysis. Again, the provisions that we've been over that do not impact Rhode Island, and the three ARPA provisions that impact Rhode Island revenues, but we do not have a mechanism to or data to sufficiently quantify that, are the tax treatment for EIDL advances, the restaurant revitalization grants, and the employee retention credit. Finally, with respect to ARPA, the fiscal year 21 and 22 estimates across all of the individual provisions, this would be personal income tax, that are estimated. Now, we worked with Office of Revenue Analysis on the earned income tax credit, the first item, and that's based on Rhode Island taxpayer data. And the other number, third from the bottom, the refundability and enhancement of child and dependent tax care credits, that was based on Rhode Island tax data. The Division of Taxation shares with Office of Revenue Analysis. So those two estimates are based on tax data. The other estimates are based on the Federal Joint Committee on Taxation, extrapolated down to what it would be for Rhode Island. And as you can see, those are relatively less than that, than the other two. I can go through all of these if you'd like, or wait for questions.
Maybe just talk through the biggest ones, the EITC and then the child care dependent tax credit.
Okay. So the first one is changes the minimum and maximum age requirements for EIC to include age 18 non-students and remove the age 65 maximum. And the refundability and enhancement of child and dependent care tax credit, it increases the amount of the qualifying expenses from $3,000 to $8,000. Rhode Island has 25% of the federal, I believe, and the percentage of expenses qualifying for the credit is also increased from 35 to 50%, and then increasing the phase-out beginning point from 15,000 to 125,000. And I can, if you have more questions on that, I can provide more detail. Great. On page 100, this is the ARPA prohibition. Again, the prohibition, as you all are aware, is stated there. The U.S. Department of Treasury has stated that it is drafting and intends to release in the near future comprehensive guidance regarding the application of this provision. No official guidance has been issued to date. On April 7th, a statement was issued, but we do not feel that this is sufficient to determine the impact of the ARPA prohibition on any changes to recoup revenues attributable to the PPP expense deductibility conformity. Page 101, question 50 is the DLT with data from DLT regarding withholding on unemployment claims. And this calendar, we summarized it on the right. Calendar year 20 is 39 million. Calendar year 21 is 11.6 million. Fiscal year numbers are stated there. And since November 1st, 2021 is 15.3 million. Question 51.
Hold on one second, please. Sorry, Nina. Steve has a question.
Nina, on question 50, the since 11/1/21, is that just really like post last testimony, or what's the significance of
Yes,
that date?
That should be since 11/1/20, since last testimony. And that should be 20, not 21.
Okay. There's nothing sent out from DLT at that time or anything, just clarifying to taxpayers that it was due. That date is only there because it's the increment above the last time you told us?
Yes.
Okay.
Yes.
Thank you.
Yep. Finally, any questions you did ask, but I would be remiss if I didn't go over the COVID-19 and other impacts on the Division of Taxation. Division of Taxation worked with a lot of other agencies, and I've itemized 2,400 Assistant Governor's Office, RIDO, DLT, and DBR. We worked on PUA payments. Hiring freeze has had an impact, and those numbers are indicated there. Currently, 46. We're actively recruiting and trying to fill positions. We are continuing to aid businesses through COVID-related penalty relief and payment plans. We've sent 30,000 mailings, assisted DEM. Powers Building reconstruction is complete. Our CRF grant work, over 2,400 hours of staff and vendor time to issue those grants. And then individual mandate hours, almost 3,000 hours of staff time on implementing that. So like everyone else, we've had our challenges, but I'm proud of the work the team has done. I'm going to turn it over to Ed Murray to do the presentation on CCU, and after that he will turn it over to Bud Craddock. I just want to, we'll send a confirming list of follow-up questions, but are there any questions before I mute myself? Turn it over.
One quick question, Mrs. Matt. UI, do you have a sense of what share claims, I guess, were had withholding for UI? I feel like I heard about half. That was the previous testimony, but in terms of claims that actually had UI withhold.
No, we don't have that data.
Okay.
But we can certainly reach out to, and I'm not sure if DLT has that data either.
Thanks.
Any other questions of Nina before we move on?
Sharon, do you want to confirm the follow-up questions?
Yeah, we can do that now while it's fresh, if you like.
Okay. Okay. Let me see if, Kristen, were you seeing them?
I'm sorry, Nina, what did you say?
Do you have the follow-up questions, or we can?
I have some. I don't know if I have them all.
Okay. Sharon, I'll send. Okay, we'll send an email, Sharon, if that works.
That's fine. Yep, we can do that.
Okay.
Thanks.
Thank you.
Okay, go ahead.
Good afternoon, this is Ed Murray. Can you hear me clearly?
We can, thank you.
Very good. I'm the Chief of Legal Services of the Central Collections Unit, and I'd like to thank you for the opportunity to make this presentation this afternoon. I'd also like to thank Director McConaughey and former Directors Thorson and Fiscal for the advice that they've given the unit over the past 9 months since I've been the Chief. And the data we're presenting today was put together by our staff, which includes Karen Vincent, Anna East La Paz, Heather Valdez, Jennifer Gutierrez, Anna Kennedy, and David Marzilli, who's the new attorney that we just hired. The CCU was established, as you know, on July 1st, 2018. It actively began collecting delinquent debt on behalf of state agencies in January 2019. I responded to question 46. In this slide, more or less general statistics, and through last Friday, April 30th, the unit has 19 MOUs with state agencies or subdivisions with state agencies. The MOUs are simply agreements where the unit will take referrals if they meet certain criteria. It is at the discretion of the unit whether or not we will accept a referral, although we accept almost all that have been given to us to date. And as far as of April 30th, Friday, the unit has collected over $2.2 million since January 2019. In fiscal year 2021, the unit has collected over $1.7 million, and there's still 2 months left in this fiscal year. There are currently 94 cases. If we could go back to page 104, please. Now 105, thank you. There are currently 94 cases open in court. This number will increase. We just filed, I believe in the last week, 10 matters in district court. District court is more open than Superior Court. However, as the courts open in May and June, we anticipate filing quite a few more cases. These are usually instances where the delinquent debtors have either not cooperated with the consumer, with the CCU, or they've just been out of contact with us. So we should see some action in Superior Court in addition to the district court cases within the next 30 to 60 days. Collections are continuing at a strong pace. In April, we collected $428,464. The last restitution, the last item there, that's $13,000. As of today, the only agency that we collect restitution for is Department of Labor and Training, and that's through the prevailing wage cases. We have a number pending in court currently, so that number will also increase, but that is not money that goes to the state of Rhode Island. That money actually goes directly to former employees. I'd be remiss if I didn't mention that the accomplishments of the staff have been tremendous in the last few months. We've increased the number of collection letters which are sent each week from 500 to 1,500, and between 200 and 300 letters per week are resent as the staff determines the correct address of the debtor, because many of the addresses we have are not correct. We're also quite pleased that our budget for this fiscal year is $698,271. That's the projected budget, and we're $1 million above that as far as the amount that we collected. Page 105, please. These are simply a breakdown of the fiscal year 2021 collections based on agency. I might point out, for instance, down near the bottom, the CRB, that's a subunit of the Department of Business Regulation. That's the Contractors Registration and Licensing Board. We just executed the MOU with them a couple months ago. The letters went out from our unit, the 30-day letters. We are starting to litigate those. In fact, I think we may have filed 3 or 4 cases last week, and we are in contact with some of the debtors. The DCYF debt of $190,000, that's actually one individual that ran and operated and owned a rehabilitation facility in Pawtucket. So that's just one case. We have a judgment against him, and now we're taking collection measures to go after him. Once again, that's determined by the openness of the court, because we have motions that we need to make, and we need to get him into court. So that'll be more of a post-COVID situation. The next page, 106, that's collection data, which is segregated by the amounts collected each fiscal year and also classified by agency. And as you can see, the totals year to year demonstrate a dramatic increase in the amount that the unit has been able to collect. The next page, 107, this graph shows the amount of delinquent debt collected each fiscal year by month. And as you can see, March, for one reason or another, has been the most lucrative month as far as collecting these delinquent debts. We really haven't analyzed why, but that, at least the last 3 years, that seems to be holding a pattern. Next page, 108, please. This chart's a month-to-month of each fiscal year comparison. So as you can see, fiscal year 2019, we just started collecting in January, and then a full year in 2020 fiscal year, and then fiscal year 2021. As you can see, the substantial increases on a month-to-month basis. Next page, please. This graph shows the month-to-month debt collections for fiscal year 2019, 2020. and 2021, with the noticeably dramatic increase in the yellow line, which is fiscal year 2021. And it's really since January that graph has almost geometrically increased. And we attribute that, a lot of that, to the increase in the number of collection letters from 500 to 1,500 going out in October and November and having a hit at that point in time. And that's caused quite a response from the debtors. Next page, please, 110. And this chart is a month-to-month cumulative comparison for fiscal years 2019, 2020, and 2021. And as you can see, as of April of this year, this fiscal year, we've been able to collect $1.7 million. Next page, please. This is a response, I believe, to a previous rep question. It's a summary of the traffic tribunal referrals. The bulk of the debt was referred in January and February 2020. And each week these numbers are updated with additional delinquent debt, delinquent being over 90 days. The unit has collected $1.5 million on behalf of the traffic tribunal, and that's based, although it's not listed here, that's based on about 4,614 separate citations. And we've been sending letters out going back, well, trying to do two things. One, going backwards in time, starting with the most recent. We're now back in sending letters out for 2014, but we also have to be considered that there's a 20-year period that we can collect judgments. So we've also been sending out letters the past year for that 20-year period, because beyond 20 years, it becomes very debatable whether or not these matters could be litigated in court. Theoretically, the debt is still owed, but the creditor can't take any legal action against the debtor. So we've been focusing on that 20-year period also. And letters were sent, and I believe that started about a year ago, to businesses through the entire period, which is why there are showing of revenues collected from year 2000 through 2013. But as I said, we're working backwards on sending out the collection letters. Next slide, please. This is response to a question regarding whether or not the traffic tribunal had ever hired an outside counsel or outside agency to collect delinquent debts. And our research has shown that no, they have not, since they were established in 1999. Are there any questions or anything I can clarify for you?
Thank you. One kind of basic question I have, are these all general revenues, or is some of this money going to other sources?
All of the money is returned to the agency. We don't send it to the general fund.
Right, but my question is, how much of this is actual revenue that will go into our revenue estimate? You send it back to the agency, so they have obligations to pay back maybe somebody else. I know you separated restitution, but in the example maybe of the Contractors Registration Board, we know those are restricted receipts that wouldn't go into the general fund. So I'm just trying to figure out how this relates to our actual revenue estimate.
I'm assuming all of it, except for if it was a restricted receipt account. I'm not sure. I can get you an answer on that. I don't know how much of it would be restricted.
So other example, the EOHHS debts, is that, if that's Medicaid, I'm assuming the state doesn't retain it, all of it?
I don't think they retain all of it.
Right,
That's
so,
also a fairly new MOU. We executed them in December.
Okay, so I think the question that we need to have answered is how much of this is actually something we can estimate as in our general revenue estimate, and how much of it is going back to other sources. So if you could assist us.
We can
with
get you that answer.
Yep, thank you. And then I guess one other question is, how does this, does this at all include any effort in terms of the refund offset that service that taxation has? Or is this after that possibility has been exhausted?
That's after the possibility has been exhausted.
Okay, thank you. Steve, you have a question?
Yeah, I had a similar question, whether the license block program had any overlap here, or if any of the receivables on this list are still also actively being worked by any of the agencies themselves?
Let me try to be a little clearer. If with the RITT matters, for instance, it is possible that we could initiate collection activities on our end, and then there would be a revenue off. If the individual were entitled to a refund, there could be a revenue offset where the state receives the money from their tax return, and that would show up as money that we collected because we started collection processes. We only take credit with regard to traffic tribunal on matters where we've actually started to collect in some form or fashion, whether it's a letter, whether it's a telephone call, where we started to collect on the debt. If we haven't started any collection activity, we don't take credit for it. It wouldn't show up as revenue that we've collected on behalf of RITT. Does that answer the question?
I think so. Thank you.
No problem.
Are there other questions, Jonathan or Matt, on the collections unit? Okay, hearing none, if you could just try and get that back up for us regarding how much of this is payable to state general revenues, that'd be helpful. Thank you.
I will do that.
Thank you.
And thank you for your time.
Thank you.
I believe Mr. Craddock is next.
Thanks,
Well-
Ed. Good afternoon.
Welcome and go right ahead. Thank you.
All right, thank you, Sharon. Good afternoon, everyone. I'm here to speak about the Real ID and provide an update on that. I'd like to thank Paul Dombrowski and Jane Cole and Maureen McDaniel who helped putting the slide together, and also Nina and her team for getting into the packet for presentation today. Real ID, as you know, is a federal program that was established back in 2005 as a result of the unfortunate incidents from 9/11. Real ID was supposed to, has been pushed back many times, and it was supposed to go into effect October 1st of 2021. There's been significant pushback by DMV administrators across the country, myself included, as well as the National Governors Association, and recently the travel agency associations, as well as airlines, have pushed back against TSA and Homeland Security about the deadline, especially in light of all the problems that have arisen because of the pandemic. With that said, the Department of Homeland Security came out, and as of, I believe it was last Thursday, with an announcement that they have pushed the Real ID deadline to May 3rd, 2023, as you'll see on the fourth bullet point down below on this slide. What that means is we'll have an additional 24 months to get this project completed for Rhode Islanders. You'll see that up till this point, we have had 77,460 of new Real ID credentials issued. 158,655 Rhode Islanders have renewed and updated their real ID, and 41,000 have come in off cycle to renew their credential and get a real ID. The bar chart shows the acceptance rate of those people that are coming in for credentials right now. The last few months, we're averaging around 61% of all credential transactions are real ID. And again, those could be either the new, renew, or the update transactions. With the extension, instead of having to get 500 and some odd thousand people cycle through between, or potentially cycle through between now and October 1st, right now, we are having 312,000 who will be coming in on their regular renewal cycle. 312,930 will be coming in on their regular renewal cycle. We anticipate roughly about 55% of those will get the real ID. What that leaves as a potential problem for us is there are about 259,000 people that are not scheduled to renew prior to May of 2023. Those are the individuals that potentially could come in for an update transaction to get their real ID. And again, if they come in at the roughly 55%, we're looking at about 125,000 people that would be coming in. And as of this point in time, about 33% of active credential holders have a real ID in Rhode Island. So overall, we're in pretty good shape compared to some of the other states that I've been in communication with. But again, if you have any questions, I'll be happy to try to answer them for you.
Any questions on Real ID? It sounds like you're saying is that basically the folks who aren't going to come in on their regular cycle, you now have almost 2 years to spread that roughly 100,000 or so out to handle the work. Is that accurate?
That's correct.
Okay.
But as we anticipated with the prior presentations we made, this will probably be more towards the second year. You'll start seeing more people come in when the deadline approaches.
Okay, great. Steve has a question.
Thank you. Bud, on the bar graph there, do we have, I know you have numbers, but I don't know how accessible they are, but of the Real ID transactions that have taken place so far over time that were not on the regular renewal cycle, that were the separate, the coming in specifically for the replacement ID?
Mm-hmm.
Can we?
Right now, at this point, Steve, it's the 41,000 have come in off cycle. Out of the, if you look in the Real ID statistics right now,
Yep.
77,000 were new transactions, people either moving in from out of state or new drivers. 158,000 came in on their regular cycle, and 41 came in off cycle.
Yeah, do you have that over time by chance?
Month by month?
Yeah. I'd be interested to see like where it falls in relation to previous Real ID deadlines.
Sure. I can provide that with you. Of that 41,000, an average is around 1,400 a month. It took a real dip March through July, actually March through June of 2020, and it's starting to creep back up over the 1,000 mark.
Okay.
But I can provide that after this session
Thank you.
on a month-by-month breakdown.
Okay, thank you. Are there any further questions for anybody we have before us today before we wrap things up?
Sharon, I have a summary of the follow-ups, just want to confirm them.
Okay, that sounds good. Go ahead.
While we're all, yeah. So, question 10C, the unused portion of the redemption, and Steve's question. 12, the percent of the refund fraud queues that are the current year, we said it was 98%. I don't know if you want the breakout of tax years.
No, that's fine. You answered that.
Okay. Question 49, clarity on the 2027, the ARPA extension on the excess business losses. Question 49, why the SBA data update, why did the loss go down? That's requested from ORA. And then question 50, how much in benefits were paid out by DLT without withholding? So the percentage of claims paid with withholding and without. We'll ask DLT that question. In terms of CCU, the percentage of receivables that are general revenue versus that are not general revenue. And then I didn't catch the DMV follow-up.
Yep, that's off-cycle walk-ins by month.
Okay.
So back to question 49, it wasn't just why it went down, it was the distribution across the years as well, because there was an enormous shift in distribution.
Okay.
And then I did ask about if any of the refunds versus finals had to do with unemployment. I think you just said you didn't have the data, but you might look at that. I'm not sure if that's something you'd be able to get to us, or that was ultimately what resulted in my question. I think you talked about for item 12. That's where that led.
That information, Sharon, if you want to, I don't know why, but I'll find out. We'll explain why we don't have it.
Okay, appreciate it.
Okay.
Anything else, Jonathan?
Nope.
Steve, you good?
Nope, thank you.
All right, and you think the statement D soon and pit sale soon after, next couple days, is that the thought?
That's what we'll try for, yes.
Okay, thank you very much. Thank you, everybody
right.
who was here today. We appreciate it.
All right, thank you.
Okay, so we are done with today's meeting, and the next meeting is the Caseload Conference, I believe, which is Thursday? Wednesday. All right. Thank you. Thank you. Bye.